And meantime, key economic data is already out of Germany and France, and it came in much softer than expected, sending the euro slumping this morning ahead of a week packed with central bank decisions, not just from the Fed. The Federal Reserve does announce its latest rate decision on Wednesday, and then we get the European Central Bank on Thursday. A year after the ECB began raising rates, policymakers are set to unveil another quarter-point increase. Joining us now to break it all down and where you should put your money accordingly, Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. Laura, glad you got the color memo here this morning. Good to see you. So I specifically want to zero in on Europe first, because we did get this disappointing data, and it really feels like more than it has been that we're seeing this sort of two-track situation between the U.S. and Europe. What's your current thinking on that region?
I think certainly the data this morning did surprise to the downside, and most evident is that we are seeing this ongoing weakness in the manufacturing sector start to spill into the services sector. And probably what was most worrisome is the fact that those key leading economic gauges like new orders, expectations for output, hiring, all fell quite sharply, which does suggest the European economy is set for a contraction by the end of this quarter, which is a divergence from what we are seeing in the US, where economic activity continues to be quite resilient.
And so, Laura, as we think about how this is also going to kind of continue to set the tone for where recoveries for the companies that we're monitoring this week that are intertwined with some of those international markets, what that continues to look like. Is there anything that would show up within earnings this week that could be tied to what the environment is in some of those international markets for the propensity of the consumer to spend and where they are still wavering through their own inflationary pressures?
Well, I think crucially, it's all about kind of the health of the consumer. In Europe, the consumer has actually been fairly resilient, despite the fact that we have actually seen negative real wage growth. So if we start to see some signs of that pressure come through in that sector, we do expect that's going to fill into more of those cyclical earnings backdrop. But again, it's all about what's priced in already. And if we look about earnings estimates for the next 12 months, notably energy, that's really a key area where we think a lot of the economic damage is already in the price. So there could potentially be cyclical opportunities in very select parts of the market.
That's quite interesting. I'm also curious, as we look between Europe and the UK, whether how you're sort of weighing those two opportunities, whether the UK has any opportunities right now.
I think the UK backdrop from an economic perspective is much more challenged, despite the deterioration in data that we are seeing come through from the European continent. And this is largely reflective of this divergence that we are seeing in price pressures. So core inflation in the UK does remain stickier and more problematic, which does suggest that the Bank of England has more work ahead of them in terms of tightening policy to try to curtail some of those price pressures. Where in the ECB, we do expect they're probably near the end of their tightening cycle. Yes, we are seeing inflation still remain above that 2% target, but they're likely going to focus more on the growth backdrop. So from an investing perspective, we do think that there's more attractive opportunities in the European equity space and the European government bond space, rather than looking at UK-specific exposures.
To what extent, and I know you cover EMEA, but to what extent are you also looking across the Asia-Pacific region and considering the inflation, or at least the prints that we're getting from Japan out right now, too?
Well, we did think that the Bank of Japan meeting this week would potentially be a bit of a surprise to the markets, but we have seen consensus shift materially in the sense that most analysts don't expect any change to yield curve control. This is on the back of recent Bank of Japan comments that suggest that inflation is really not yet seeing signs of being sustainable. So there is, of course, this risk that we could see a kind of a shock move later this week, but that's not our expectation. So we do think that this monetary policy divergence will continue to persist between a lot of the other developed markets and Japan. And it's one of the reasons why we do like attractive exposures in Japanese equities. But again, we are really thinking more about kind of taking on the defensive quality tilt within the US and within Europe is probably a bit more attractive at the entry points right now.
So, Laura, where do you feel like then globally you want to take on a little more risk? Are there places where that is more appropriate right now?
Well, I think the key question that we've been asked is we've seen this tech-fueled rally in the US on the back of this secular wave of AI, and that could be challenged this week if we do see those earnings reports come through not really being backed by kind of the fundamentals around profitability. So we're questioning the sustainability of that rally in the near term, but it is opening up pockets of opportunity in some cyclical components of the market. As I mentioned, energy, we do think that's, a lot of the damage is in the price there. But overall, we're taking this defensive quality approach, continuing to seek those exposures where we aren't seeing that margin compression, where we do see demand resilience. But crucially, I think forward guidance in earnings season will be one to watch to really decipher where those key divergences are coming out and where those tactical alpha generating opportunities lie.
Perhaps you could break that down just a little bit more for us. Demand resilience without margin compression and how you look at it from your perspective.
I think the key sector that comes to mind is around healthcare, and healthcare in Europe in particular. It does tend to be a defensive sector. It does have that inelastic demand. We are still seeing some signs of that pent-up demand from COVID, but as well, it's going to benefit from the long-term trend around aging demographics. So that's one area that we do like to take opportunities in. And then I guess thinking more regionally in light of today's data, we do think that periphery equities across Europe, so Italy, for example, Spain, have actually been strong performers year to date. And we do think there is further scope for upside given their sector composition. So tourism exports did come under pressure in today's PMI data, but we do think there's enough demand there to support that key areas of these equity markets. And as well, industrials and the luxury sectors in France in particular, industrials have actually been fairly resilient despite the contraction that we have seen in manufacturing. And we think this accelerating destocking of inventories is probably reaching an inflection point. So we are going to see an inventory build that's going to provide a tailwind to industrials. So we do like that composition in France in particular as well.
Laura Cooper, BlackRock Senior Macro Strategist for iShares EMEA. Thank you so much for joining us.
Thank you.
Thanks.